Okay, everyone, welcome again to another season of the Accounting Design Project. I think we're into our fifth or sixth year. We started this back in the pandemic when Zoom was the way to go and found that this was a very good medium to bring a worldwide audience together. So it's good to see everyone again for a new season. I think we have 10 or so papers pretty much every second week. So we hope you can spend some time with the Accounting Design Project. So welcome. We look forward to another stimulating season. So I hand over to Waqar, who now is going to be the moderator to keep Andrew in order.
Thank you, Steve. Welcome to this season's Accounting Design Project, and I will be your moderator today. My name is Waqar, and I am an assistant professor at HEC Paris. I welcome Andrew Atkeson to start our series with his paper on reconciling macro and finance, the US corporate sector, 1929 to the present. Just some housekeeping rules before we start. Please mute your audio to avoid background noise while the speaker is presenting. If you share your video, we can have an interactive, fantastic experience together. Please raise your hand or chat in the chat box, and I will call you in the order of raising your hand. For the first 5 minutes, please give Andrew time to set the stage, and then after that, he will be open to your questions. With that, once again, a very warm welcome to everybody, and to Andrew, the floor is yours.
So thank you very much. Thank you for inviting me to do this. I am a macroeconomist, but I have become, with my co-authors, Jonathan Heathcote and Fabrizio Perry, kind of interested in a national accounting exercise that's been made possible by new integrated macroeconomic accounts. They're not that new, but we've been working with them for about 10 years, that I will describe, and it's kind of the basis for this. And let me just say, for ground rules, I'm happy to take questions at any time. I may not notice, so Waqar, if you can just interrupt me and say there's a question, that would be great. So what we're interested in is the following reconciliation. So what I want to show here, and I'll describe exactly what is being measured here in greater detail in a second, is I want to show a measure in blue of a measure of the market valuation of all the corporations in the US corporate sector relative to the output of that sector from 1929 to the present. So what you see is that blue line is quite volatile, moving up and down. In contrast, there's a red line, which is a measure of the replacement cost of the capital, the measured capital in the corporate sector. And at least after World War II, you see that red line relative to gross value added is quite stable. Something that struck us that we didn't really know before we started looking at the historical data is that prior to World War II, that red line was actually quite volatile. Now, why is this a puzzle? Why is this something to be reconciled? If you think in terms of a standard growth model, and perhaps this is standard in accounting, the value of firms should be the value of their installed capital. And you can talk about Tobin's Q as the earliest, an early statement of that principle. And it seems like before World War II, maybe...
We have a question by Paul.
Go ahead, Paul. Yes.
Quick question. For those of us with a long memory, this looks a lot like the graph that Schiller showed in his 1980 79, 80, I forget exactly the year, excess volatility paper. Could you just kind of, where is this really different?
Okay, so conceptually, they're going to be related. The one benchmark that Schiller emphasized is the valuation relative to some discounted present value of expected future cash flows.
Right, dividends. Yeah, that's right.
Okay. Another metric is that independent of expectations of future cash flows or rates of return, value should be equal to installed capital. So there actually was a competing book to Irrational Exuberance that used Tobin's Q, or the ratio of the market valuation of firms to installed capital, as the metric rather than something like CAPE, which Schiller made possible, which is a flow of earnings relative to value. So in the end, we're going to have cash flows, installed capital, and valuation. And the idea is to try to reconcile all of those. But from the macroeconomic perspective, the way I would put the puzzle relative to the conventional wisdom in finance, conventional wisdom in finance would say that blue line is volatile because there's time-varying expected rates of return. I mean, some people would say because of bubbles, but let me put bubbles aside for a moment. And the puzzle for, I would say, not just macroeconomists, but also corporate finance is, well, if the cost of capital is measured by the expected return on the market is moving up and down a lot, why isn't investment, and hence the capital stock, moving up and down a lot? That's another way to say the puzzle in Tobin's Q. So what we want to reconcile is that firms, at least post World War II, have chosen very stable capital output ratios, and yet their valuations are going up and down all over the place. Does that reconcile it? So it is related to the Schiller graph, but it's not exactly the same. So
No, that makes a lot of sense. I mean, market valuation is very volatile, right? I mean, goes back, I don't know how far. Schiller,
yes.
and then there was the Roll and French and Roll.
Yes. Many papers.
Right,
Yes,
many
totally.
papers on that. Okay, his was dividends. All right, I mean, I want to listen to what you have to say, but I think it's all part of the puzzle.
Yes, no, 100%. I agree with that. So Suresh?
We have another question yet.
Yeah. So Andrew, so when you talk about the capital here, are you taking only the physical capital? Are you also including the intangible capital? When you look at this valuation, right? So when
Can I postpone that discussion? So strictly speaking, this is measured, what's reported in essentially fixed assets from the BEA, which is also what's in the integrated macroeconomic account. So you've raised an important question. I want to, I said that I would address that, and so I'll show in a slide or two. Okay, so just to give a sense of what these data are, the integrated macroeconomic accounts that I'll talk about in a minute offer essentially for the major sectors of the economy integrated income statements, cash flows, transactions in assets, and then balance sheets. And it reconciles them all in one big sheet. And so what it has on the balance sheet is some assets and liabilities that I've put in the categories of non-financial assets, which would be measured typically in fixed assets, though there is some inclusion of land, then value of financial assets, variety of liabilities, and equity. And so they report both the reproduction or the reproduction value or the reproduction cost of the fixed assets, the non-financial assets, and they report the market valuation of the equity. So that balance sheet doesn't add up. You have to, in the standard way, either if you're going to put the reproduction value of the non-financial assets in as the red line, then equity has to be the residual. Or if you put the market value of equity in, we're calling enterprise value the residual. So our definition of enterprise value is going to be the sum of liabilities and the market value of equity minus the value of financial assets. And that was the blue line. And then the red line I showed you was the BEA estimate of fixed assets, basically. And so this market valuation is now reported in the financial accounts of the United States, which used to be known as the flow of funds, on a certain table called B1. They started that in about 2016. So you can, that's what we just downloaded that data and compared the two. So what do we do in the paper? We first look at, as the first question I got, what are the cash flows that we think are being valued? What is this enterprise value that we look at? And what are the returns that are implied by these macroeconomic data that I'll talk about, the integrated macroeconomic accounts? How do they compare to the returns that we see from CRSP or for public firms? And the reason we do this exercise is, the reality of constructing these integrated macroeconomic accounts is kind of like sausage. The BEA and the Federal Reserve have to make tons of imputations. There's a lot of things they need to do to come up with these measures. And so I just want to say, what do these data look like? They're kind of useful in comparison to what we have to public firm data. And then we want to construct two valuation exercises. So one is relating to the first question I got. The tradition in finance following Shiller, but actually Campbell and Shiller, and I'm referencing a paper, but the first Campbell and Shiller in 1987, and then a Campbell-Kyle paper in 1993, is you have a model of the dynamics of the cash flow being valued, and you run some regressions to try to uncover what the drivers of value are, whether they're changes in, expected future cash flow or changes in rates of return. So I'll do a standard finance valuation exercise. And from that, I'm going to get, in the paper, we get an estimate of, okay, these would be the time varying expected rates of return that would reconcile the valuation and cash flow data. And then we go to a macroeconomic model that has in it two things. We modify the model. The standard macroeconomic model, you have this Tobin skew equals 1. So there's nearly not much to do. The observed capital is value. And clearly that doesn't hold in these data. So we augment the model to include firms derive value from a pure rent that we call factorless income, and from their physical capital stock. And so we use the stochastic growth model to say we're going to divide up the observed cash flows and value that we see into a portion that's due to the rent, to the factorless income, a portion that's due to the physical capital. And then we will have from the model returns to investment in measured capital. And we want to see if the two line up. The reconciliation would be, can the expected returns from the finance valuation exercise line up with essentially what we call the capital Euler equation, or if you're familiar with Hall and Jorgensen have a approach, but they use what they call the user cost of capital to assess the capital Euler equation. And we'll argue in the paper that the two line up fairly well, so that you can actually kind of reconcile the finance view of what's driving value with the macroeconomic view. So that's the goal in the paper. Now, I got this question, or maybe you're just mismeasuring capital. And so we briefly discussed this in the introduction, but I'll add some slides if we have time at the end. There's been a lot of interest in that there might be forms of capital that are unmeasured but are contributing to value. And a lot of the work that I'm aware of in finance is what I would call cross-sectional. So it looks at a cross-section of firms and tries to use estimates of how much unmeasured capital they have to try to explain things about their value. But if you think about the time series, and in particular, the recent boom in market valuations, say over the last 20, 25 years, the time series that I'm aware of have this problem that intangible investment has such a high depreciation rate that there's actually very little of this capital accumulation from what I would call standard estimates. So I would say and this is what I hope to get to at the end of the talk, is that the aggregate data available to date are not consistent with unmeasured capital being a significant driver of these valuations. So that's what I hope to do, a little bit different than the paper, because I thought that in this group there might be interest in this topic. Okay, so let's go ahead.
So Andrew, I mean, quick question. So if you look at the BEA, right, BEA seems to be collecting a lot of intangible asset data. They're publishing that data. Why is there a reason why IMA doesn't look at the intangible data as well and come up with a balance sheet that includes the intangibles?
Okay, so there's two types of intangibles I want to emphasize. There's starting, I think, in like 2013, the BEA started moving a bunch of intangibles in: software, artistic originals, and
R&D.
well, they estimate an R&D capital stock. And then there's groups of people who argue that you should include other things. So I'll call that measured. So the data we're using that's now in fixed assets. And so those items are in our capital stock. Then there's people who argue that you should include other things. There's a team, Carol Corrado, and a team who, she and her team recently had a paper in the Journal of Economic Perspectives, but she has a long series of papers saying maybe we want brand equity, maybe we want organization capabilities, maybe we want other things. And they propose methods to, essentially use a perpetual inventory method to construct capital stocks for those as well. And that's what I want to get to when I get to this red line. So there are some types of intangible capital that are measured and in these accounts, and then there's possibly other types that are not. And then another group that I'm aware of is my colleague Andre Eisfeld and Dimitris Papanikolaou do a bunch of stuff with sales and general administrative expenses to try to estimate an intangible capital stock. And I believe that their series has the same issue that I'm going to discuss at the end here. So, which is that it just turns out not to be very much of this type of capital in the aggregate.
Thank you, Andrew. Thank you.
That's the plan. All right. So I would encourage you, if you have an interest in this thing, to go to the back of the financial accounts of the United States, where the integrated macroeconomic accounts are listed. And for me, even though I'm not an accountant, it's a thing of beauty, because they just give a consistent set of, what's the value added in a sector, what are the property income flows in and out, what are they doing with those with that cash in terms of acquiring capital, acquiring financial assets, paying down liabilities. They have a revaluation of every item on the balance sheet, and then a change in the market value balance sheet, all in one nice coherent framework. And as I say, there's tons of imputations that are done to construct this. What I'm going to focus on, and this is driven by the UN updated the system of national accounts in 2008. And so this is a format that everybody is supposed to follow eventually. The US is by far and away furthest along in constructing these integrated macroeconomic accounts. So, and the accounting standards are a little bit different than what we normally do for NIPA, so there's some adjustments, but let me just hold off on that detail. So thinking from the perspective of a growth model, or going back to, say, Modigliani Miller in 1961 about the irrelevance of the timing of dividends, we want to have a cash flow measure that we think of as fundamental, that we call free cash flow from operations. So for the corporate sector, that's easy to construct. It's the gross value added of the sector minus all the taxes they pay, the indirect business taxes and the corporate profits and property taxes, minus compensation of labor, and then minus expenditures on measured investment. So that would be gross fixed capital formation. So we're going to call that free cash flow from operations, and that'll be our cash flow measure. And then I mentioned this enterprise value measure, which is we're trying to, strip out the impact of financial assets and the debt equity mix on valuation by focusing on enterprise values. So we take the market value of equity plus the liabilities minus the financial assets. And let me just note on this bottom, go ahead, Stephen, you have a question?
Andrew, I was very interested. I read your paper, there's no earnings. Okay. We accountants typically think as free cash flow is not a very good measure and actually induces volatility. Because when you invest a lot, you reduce free cash flow, but actually you're adding value. Earnings doesn't have that problem. So if you get more volatility, you invest, you get lower free cash flow. But when it pays off, without further investment, you get higher free cash flows. So what was basically your choice of using a free cash flow rather than earnings?
Okay, so I come from a macroeconomics background and not an accounting background. So in the first year of our courses, when we teach the growth model, we imagine firms as being all equity financed and not having any financial assets. So they just pay out the thing we call the dividend when we teach the growth model is this object free cash flow. And I am very interested in earnings. So I would say the macroeconomic analog of earnings, if I thought about firms being 100% equity financed, would be you instead of using investment as the last item in the formula, you would subtract off consumption of fixed capital. Okay, so that would be the measure of earnings. But then of course, if you change the debt equity mix, earnings is altered. And so we are going to have the model match all the data, including the data on consumption of fixed capital. So in this reconciliation, we will also be matching the dynamics of earnings. But I'll show you the picture. I'll show you two pictures of kind of why we went to. So I mean, we're coming from a macroeconomic bent, and let me just say that's a legitimate question that I don't fully have an answer to at this time.
Okay, but I just keep in mind, if in fact firms have pension plans, okay, the cash flow is not until 30 years hence. The accrual accounting actually picks up in earnings the liability and the
right. It's
a question of accrual accounting, I guess, versus cash accounting.
Yes, so we're trying to do cash accounting.
Yeah. Okay. Okay.
That's the way we're thinking about it. And okay, and so the first, I just put here a note, the residence principle. For every country, GDP, the measures of macroeconomic, of activity in the national accounts are based on the residence principle. So for corporations, that's corporations that are incorporated in the United States. So that is the US operations of US multinationals. It doesn't include the foreign operations of US multinationals because their subsidiaries abroad are foreign corporations. And likewise, it includes the US operations of foreign multinationals. So Toyota America is a US resident corporation and goes into gross value added of the US corporate sector. So the residence principle also creates a difference with then like worldwide consolidated accounting in public firms. But the way that's handled in here is that in the accounting, they enter in the claim that US multinationals have on their foreign subsidiaries is treated as a financial asset. and the claim that foreign multinationals have on their subsidiaries is counted as a liability. So when we compute enterprise value, we're also computing it in a way that's consistent with the residence principle, with the macroeconomic data. Now, this is a huge issue in accounting. If you go over to Europe, Philip Lane, who's the chief economist of the ECB, thinks that the residence principle is just a mess in a place like Europe, because like, how do I tell, what's a German or a Belgian or an Italian corporation in an economically meaningful sense? But this is the way the data come to us and the way they're structured. And hopefully for the US, I'll show you some pictures. This is kind of good enough. So the first thing we just want to do is we can take this series from 1929 to the present annually, and we can construct returns that are implied by the aggregate data, and we can compare them to returns that you get from CRISP annually. So the first thing we liked is they kind of line up. Now, there's a couple of reasons why this is a 45-degree line, and the CRISP annual returns in, subtracting off inflation are on the x-axis, and the IMA returns that we constructed are on the y-axis. There's a couple of reasons why they don't line up perfectly. I mean, one obviously is there's a lot of in the IMA, you have to impute valuation to private firms. You have to impute valuations to subsidiaries at home and abroad. As I mentioned, lots of imputations. We're looking at enterprise value rather than equity. And again, this is, CRISP has worldwide operations. This has US operations. In the paper, in the appendix, we have a comparison. We can use the IMA data to focus on equity returns, and those line up even better. So some of this difference is due to this different measurement concept, and the correspondence of returns gets pretty close if you compare equity returns here and there. And some people might say, this is artificial, because in the IMA, they used public firm data to impute the valuation of private firms. And I'm like, okay, but I'll let them do the imputation rather than me do the imputation. Because as you can imagine, that's a big problem. But we're going to go with that there. So that's the first thing, is that we're kind of looking at similar returns. Now, this picture surprised us, which is, just straight from a NIPA table for the corporate sector, which is free cash flow over corporate sector GVA. And it's quite volatile at low frequencies. And I used to be skeptical of the idea that there's been some change in market power or some change in the profitability of US corporations. But when I saw this graph, I said, no, something has really happened into the division of corporate value added into a share that is available to firm owners in the aggregate versus labor. And so we're all familiar that the labor share in the corporate sector fell quite dramatically after about 2000. So a lot of what's going on here is that drop in the labor share. You might ask me, why was free cash flow over corporate sector GVA so high in the beginning of the sample? And that's much more connected to the fact that the capital output ratio was much higher in the beginning of the sample. So if you think of a simple benchmark on a balanced growth path for what free cash flow over GVA should be, it should be something like R minus G times K over Y, or K over GVA. On a balanced growth path, the income, and so a number like 0.05 would be a capital output ratio a bit over 1 times R minus G of, say, 3 or 4%. But there's been this massive increase in the last 20 years, and it was quite high before. And this is not unique to the NIPA data. We're not accountants, so we kind of read a few papers, and we got the sense that maybe from CompuStat, a quick and dirty way to do free cash flow is from the cash flow statement, this OANCF minus CapEx. And so we aggregated that and divided by the same denominator, which is, integrated macroeconomic accounts, corporate sector, GVA. And so we see in the aggregate in the CompuStat data also that there's been a big increase in this cash flow since about 2000. So we have some feeling that this is not an artifact of the NIPA data. Okay. And so then the first thing we do is, well, let's imagine it as a benchmark that you took like a Gordon growth model and you said, well, the value should be, free cash flow over GVA divided by some R minus G, and let's use 3.2% for this picture. And so that's the red line, and then the blue line is the data that we're trying to explain. So we say, at least at low frequencies, these two series seem to have something to do with each other. And when we get to the finance exercise, so you may remember Campbell-Schiller 1988 is the much more famous picture where they use a log linear approximation. But in Campbell-Schiller in 1987, they used a thing they call the price dividend spread, which is, I show the equation there. And that is just the difference between the blue line and the red line. And that valuation metric is quite stable. I mean, it's quite volatile in a transitory way, but it's quite stable over the long run. And so this is the valuation metric that, as I say, Campbell-Schiller 87 and Campbell-Kyle 1993 use, and that we're going to use in our finance exercise. And okay, so I'm going to go over this like super fast because this is finance and we're still working on it. We basically follow Campbell-Schiller 1987. We say that the cash flow we're interested in, I'm calling here D is free cash flow over GVA, is the sum of a transitory component and a permanent component. So that's getting at the fact that the red line has these very low frequency movements. And then value has the discounted sum of dividends plus a residual. This is the framework. And then we try to estimate the dynamics of the residual and the cash flows from this. And we use a simulated method of moments. We're using the fact that this price dividend spread valuation metric should predict what we call what Campbell-Schiller call quasi returns and changes in cash flows. And we say it works pretty well. And so what comes out of this valuation exercise is a picture different from what the standard finance picture is. So the blue line is enterprise value over GVA is what we're trying to model. I'm sorry, that's free cash flow over GVA. And we do this decomposition of that blue line into a permanent component and a transitory component. The permanent component that came out is the red. The transitory component is the yellow. And so we say, like, there's quite a lot of low frequency movements in this free cash flow over GVA, and those end up driving most of value. The portion of value that is driven by time varying expected returns is this red line, and the value is the blue line. So with this data, I'm sure we're going to have to argue with finance people a lot. We end up using the Campbell-Schiller methodology, a very different picture of what's driving value than people normally think. But we do get time varying expected returns. That's what's in this blue line, is what came out of this exercise. And it's just that the movement in expected returns is quite transitory, and hence it doesn't end up having a big impact on valuations. So, but as I say, I'm sure that we're going to have to fight to the death with referees on this. So I prefer to hold off on that. I'd like to get into the macro accounting if I can. So just imagine that from this exercise or from some other return forecasting exercise, one is handed a series for expected returns. And we now want to ask, what's a macroeconomic model that would rationalize all the data we see, in particular, the capital output ratio with those returns. And so we're going to have to confront firms' decisions to invest. And so I'm going to show a stochastic growth model that has a modification so that firms earn a rent that I'll discuss that we call factorless income. And then the purpose of the model will allow us to divide the sources of enterprise value into some of it's from the installed capital and some of it's from the discounted present value of this rent. And the free cash flow, some of it is a compensation to the physical capital and some of it is this rent. And so I want to discuss how we do that. And then the model says, these are the realized returns to investment in physical capital, given the data we see. Are those consistent with whatever series for expected returns you got? Either you're like Moses and somebody told you the expected returns on the stock market, or you did it from our estimation exercise. Okay, do you have any questions about the purpose of this? Is everyone okay? All right. All right, so as I say, go ahead, Paul.
I just have one question. I noticed in your graph before, there were a couple of places, this one here, where the expected return was negative, if I can see it.
Okay, this is net of expected growth.
Oh, net of expected growth, okay.
So this is like a R minus G. So that we're working, because we're working with value relative to GVA and cash flows relative to GVA, the measure of returns that comes out is net of GVA growth.
Okay.
Plus one.
So it's not negative expected return. It's not a real negative expected return.
Yes, that's correct. Though in 2000, it's getting close, because expected growth is about 3% usually. So, okay, so the production function for the corporate sector is they use physical capital and labor, Cobb Douglas. The Z is aggregate productivity shocks, and we're just going to have labor be exogenous. The capital services that you have are the standard accumulation of physical capital, but what's reported in the accounts is a nominal value of the capital stock. So there's some replacement cost reported at T, there's some replacement cost reported at T plus 1, and that is the aggregate of nominal expenditure on investment less nominal consumption of fixed capital, plus a revaluation term that is not particularly very large unless inflation is high, that is having to do with the price index for investment goods. So this isn't like a market revaluation. This is it's like going from historical cost to inflation adjusted cost when you do the fixed assets. All right, so and then we assume that firms are paying a collection of taxes. They pay indirect business taxes, which we get to see in the data, and they pay corporate taxes that impact the incentives to invest. And there's a relatively standard, there's an investment tax credit, and there's relatively standard then effective tax rate on investment in capital. So the taxes can impact the desired capital stock in kind of fairly standard ways. So we take what we hope are standard series on the tax rates and how they've evolved since 1929. We could probably use suggestions on better sources of tax rates. The blue line is the indirect business tax rate, which hasn't really changed much, but the yellow line is this effective tax rate, is the tax wedge between the cost of capital and the marginal product of capital that you would get. And that has evolved a lot over time. And that's kind of important for our analysis. But here's the factorless income, which I think is the core. I got to be mindful of the time. We just assume that the revenue that firms receive, there's a wedge mu between that revenue and their cost of the labor and capital that they hire. And RK is an imputed rent for physical capital. And so instead of having the usual division of income into labor compensation and compensation of physical capital into two components, we have it divided into three components. There's a pure rent, which we call factorless income, and then there's a labor compensation share of income, and there's a physical compensation share of income. Okay, so the question is, there's been a big debate in macroeconomics about like how much rent there is. We're going to use a very simple identifying assumption, which is, let me go back here a second. With a Cobb-Douglas production function, the share of labor in cost is constant at 1 minus alpha. The share of capital in cost is constant at 1 minus alpha. We're going to assume that alpha has been constant over time. With that identifying assumption, we can read the wedge off of the observed labor share. If you just look at the equation WL over GVA, we get to see indirect business taxes tau S. We pick a value of alpha, we did 0.29. And so then you can just read the wedge right off the data. So this is a very important and stark assumption. And so it's this that gives us our division of factorless income, free cash flow, into a portion that is compensation of physical capital, that's the blue line over GVA, and a portion that is the rent, that is the red line. And so you see, what I want you to see here is that the recent boom in free cash flow is driven largely by this wedge, whereas the prior boom in free cash flow was seen to be very much a compensation of physical capital under this stark identifying assumption. And then how do we divide? So this is how we divided free cash flow into factorless income and compensation of physical capital. How do we divide value? Well, we use the benchmark that with a tax adjustment, the value that is due to physical capital is just a tax adjustment 1 minus lambda tau c times the replacement value of the capital. That's the Tobin skew part. And the residual is the part that is due to factorless income. And so this gives us, well, I'll go way back here. This gives us that, at least since World War II, the portion of value that is due to physical capital has been quite stable. That's actually what the red line is with the tax adjustment. The portion of value that's due to the rent is the difference between the blue line and the red line in our analysis. And that's what's driving the volatility. Okay, so then we ask if we want to reconcile the finance view and the macro view. With all this divisions, we can compute returns to physical capital. You know, with the two identifying assumptions I said, the fixed share of labor and cost allows us to know what free cash flow is going to physical capital. The assumption of no adjustment costs in investment, giving us Tobin skew, tells us what the valuation of the capital stock is. And so we can compute the realized returns to physical capital just straight from the data. And we need to compute the expected returns to physical capital there. You need to make a bunch of assumptions. But let me show you, without getting into the picture, into the details there, the left-hand side shows the model implied realized returns to physical capital in blue, and the model implied expected returns to physical capital in red. And these expected returns to physical capital are computed so that they match the expected returns to enterprise value that we computed from the finance valuation exercise. So this gives us a picture in the right-hand side that after World War II, the expected return to physical capital that would rationalize both the valuation from the finance perspective and the observed quantities of capital is most of the time about a 5% premium over a safe rate. Something went on in the early 1980s that's a bit puzzling. And obviously in the Great Depression and in World War II, there's wild stuff going on, but it's the Great Depression and World War II. And we're imagining that that's what the problem is. Yes. So Paul?
Yeah. So in the beginning, when I asked you to relate it to Schiller, and you said your motivation was that if there is this great volatility in the expected return, we should see investment having similar volatility because investment should respond to the cost of capital. Okay. Yes, that's true, but shouldn't it also be the case that there are frictions and transactions costs? You can't just start up investment or stop it that easily. That would be a wedge in there. You didn't talk at all about that. I think that would be part of the explanation, wouldn't it?
Okay, so yes, I see this as an exploratory exercise. We're going to go to the extreme of no adjustment cost to investment. And that allows us to do this split into value very easily because then we have Tobin skew.
Okay.
I don't think it's that hard to modify the model to include some adjustment cost to investment. And then the ratio, if you do it in the kind of the standard way, like Hayashi, then the ratio of investment to capital is going to become an important variable because that would be the Fumio Hayashi has the famous paper that would be your adjustment to the valuation of installed capital that you'd want to do. So that may help the reconciliation fit even better than what we're getting. But for now, we wanted to do it in kind of as stark as fashion as possible. So
that makes sense.
But I want to stress that the first step that was very important to us is that the IMA data on cash flows give a different picture of the drivers of value than what you get from CRSP data on price per share and dividends per share. We got cash flows to be much more important than what you get when you do valuation exercises with CRSP data, specifically on price per share and dividend per share. And that result that we have harkens back to a prior result by Lorraine and Yoko from 2008. It's a paper maybe not so many people pay attention to, but they made the same argument with similar data. And so I'm sure we're going to be fighting with finance people over this.
Can I ask you one more question?
Sure.
So you created this series of expected returns or cost of capital. Maybe I missed something in what you said, but can you validate it does it line up with anything like some measures of stock market volatility or rates on, long bonds or anything like that? Did I miss that?
No. Okay. So the validation, I mean, I was mindful of the time that we have about 12 minutes. What we do is when we compute expected returns, you have to compute the expectation of the numerator here. And one of the items that goes into that expectation is what you think growth is going to be. And so we're using on the left-hand side, we want expected returns to capital to equal what we got from the finance valuation exercise. And the degree of freedom we have is expected growth of GVA. And so, I mean, you have to make assumptions. We say taxes and the wedge and all follow random walks when we construct that expectation. So the place that, do I show it? No, I don't, I'm sorry. In the paper, we show a graph of what the implied expected growth of corporate GVA is and the realized growth of GVA. And that's where what I would call the error of the model would appear. So you look at that graph and you might say, that red series that you have in the paper I'm not convinced that that's actually expected growth. And so maybe adjustment costs would help with that. So that's the main place. It's like this methodology, if it didn't work, the way it would show up is you get, wildly unrealistic expectations of growth to reconcile the two. Suresh, did you have a question? Yeah.
I'm building on what Paul asked before, right? So for example, if you look at from 1940s, the expected return seems to be going down. But if you look at the actual data, the expected return, at least the realized returns from the stock market are actually going up. After World War II, returns are higher compared to the pre-World War II. But in your graph, expected return imputed is more, I mean, it's significant decline from 10% all the way to less than 5%.
Yeah, so okay, so during World War II, you have a number of issues. You have a lot of government involvement in investment decisions for war production, and you have GDP is massively inflated by, military expenditure. And so when you compute a capital output ratio, I'm guessing that the reason we're having this very high expected return to capital during World War II is those two things are going on. So your capital output ratio looks really low.
I mean, even ignoring the World War II, even if you look at from 1960s, from this graph, I mean, I would say that expected returns are going down.
Yes. And so expected growth is going down as well. So that, yes. So that actually is what I wanted to give time to do. So let me, I think you guys are, okay. This is from the finance exercise, expected returns net of expected growth. So you notice that does not have a downward trend, but the level of expected returns, this is returns minus growth. So if growth is going down, you can accommodate returns going down as long as you have growth going down. And that's what we need for the capital stock. That's going to be super important to get this. This is now the level of returns. Returns are going down, expected growth has to be going down. Now, this is going to be, the fact that returns are going down is going to be super important, because if you go, you're going to say, Andy, you're trying to tell me that blue line boomed of value in the last 20 years because the wedge between revenue and cost got bigger. Okay. And if the wedge between revenue and cost got bigger and long run expectations of that wedge got bigger, you should have a secular decline in the capital output ratio. If you held fixed the required rate of return and you have this wedge, then you need a lower capital output ratio to validate that rate of return and to be consistent with that rate of return. So we have to say, as Philippon, and I think Gutierrez and Philippon and others have said, that the way to understand the stable capital output ratio for the corporate sector over the last 20 years with rising valuations, you need to put together this rising wedge between revenue and cost and declining required rates of return. And those two things have miraculously offset to give you your stable valuation. But I would say the big picture that we get out of this is how we reconcile the blue line and the red line is that we say this wedge, or expectations of the amount of rent that firms are going to earn as factorless income, has a very large permanent component that, as investors look at that, they say, oh, I'm going to get this rent that's bigger now permanently. That has a very big impact on value. It has a valuation multiple like 1 over R minus G. So it's investors' expectation of that rent in the distant future that is driving the valuations. In the near term, that doesn't affect the capital stock much because it's only tomorrow's wedge that matters for investment in the capital stock. And that's how we can get, at least in the short term, stability in the capital stock. Now, I wanted to save time, and we have a few minutes for this question that we didn't discuss in the paper, but Suresh, you asked me about it, about unmeasured capital. So as I say, so there's a group, I don't know if you know them, they go under the name Intan Invest, Corrado, Haskell, Jonah, Lacino, and Naomi, that try to do across many countries a consistent set of measures of capital that is not measured, and say we should add this to the national accounts. And then Eisfeld and Papanikolaou have a series of measurements there. And so one reason we like the free cash flow measure is that that measure is invariant to whether there's unmeasured investment or not. If the cost of that investment is unmeasured, it's treated as an intermediate expense. If it were measured, it'd be treated as an investment expenditure. Either way, it's subtracted from free cash flow. And but anyway, so what I just want to show
you have 5 minutes left.
Yeah, I just want to show you the key graph. Corrado, Haskell, I mean the Intan Invest, they produce measures of intangible investment, and they say, look, it's unmeasured, and they say, look, it's really big. This is important for us to consider. But they also provide a measure of the stock of capital associated with that unmeasured investment through a perpetual inventory method. And for that, they need to estimate a depreciation rate. So if you take, I just downloaded their data, and if you take their estimate of the ratio of unmeasured capital to total capital, so this is not the ratio of investment, it's the ratio of unmeasured capital to total capital, it's 7%. It's not going to do anything. If our goal is to explain why value has skyrocketed by multiples of corporate GVA, multiples of the existing capital stock, I would say in the time series data, this measurement procedure is like a dead end. Yes.
Andrew, just want to point out that doesn't, for someone, in accounting who sees that things like R&D expenditures have gone up, just orders of magnitude in the last X number of decades, to 7% and a constant, that doesn't seem right.
Okay.
You think it should be going up over.
So what you have to have in mind is that the depreciation rates are huge. So like for software since 2013, in the fixed asset tables, the depreciation rate's 50%. So if you use the perpetual inventory method to construct a stock of software, you can have very large investment and you're not going to get anywhere because half of it disappears every year.
What about patents and things like that, which protect the value? It just 50%.
Okay, no. So this is the meat. Okay, so this is the meat of the argument in my mind. Somebody has to say these depreciation rates are wrong by a lot. And that's, that I think is the crux of the argument, to say that you always have this problem if you want to estimate an unmeasured, even when we do fixed assets, you have to come up with a depreciation rate. And that's I think really the challenge. I mean, if other people have other measures that accumulate into big aggregate stocks over time with trends, I'd be very interested to see them. And but that's the reason at the end of the day why I come down to the point of view that this is rents and not accumulated capital is the other feature Stephen mentioned. If there was a big investment in unmeasured capital that has led to this boom in free cash flow, I look at the series on the left and I say, when did they do the investment? That should have depressed free cash flow. And to accumulate a capital stock that is multiples of the installed capital, that would have to be a giant investment. And so I would say, when did it happen? So my view, if I can finish with it, because 1029, is that perhaps there was investments in new forms of capital, say data, if we're thinking of the tech firms. But I think that the value of that capital turned out ex post to be a surprise. That the realized return that these firms got on those investments in that unmeasured capital was much higher was a surprise, and hence much higher than the cost of capital. So I would say that point of view would be, it's a windfall. How is a windfall different from a rent? And would be the question I would ask. It's not something that is sustained by further investment. So I just wanted to end right at 10:30. I think for accounting people, at least get involved in the arguments about how we should do national income and product accounting. These groups are responsive to feedback and they are engaged in, it's an international effort. They are engaged in interesting discussions. But the main thing I want to take away is over the long run, there's been plenty of volatility in free cash flow. The third point about giving similar approaches, I'm sure finance referees will beat us with a stick. So we'll see what happens with that as we go along. And I do think, I'll put it for this audience, I'd call there's lurking questions about unmeasured capital, that how can it be so important in the aggregate unless we're just really wrong about the depreciation rates that we're using, that people are using to accumulate that. All right, so with that, I'd like to thank you all.
Very interesting. Thank you.
Andrew, would you like to announce the next session?
Oh, I'm sorry, I forgot to put that slide.
No, that's okay. That's okay. I can do that.
Did I
for
ask you to do that advertising?
Yeah, no problem. So for everybody, we have our next session on February 4th, which is on confidential advertising expenditure by Pot Su from National Tsinghua University, Taiwan. See you next time.
Thank you.
And I'm happy to stay for a few